itself is a higher because they are having a listed company shares, which is a tradable shares, which is frequently shares, and you can understand the value of these investment and you can compare. But their book value because of this is higher, but it is trading at a lower price. This discrepancy between market price and book value is affecting liquidity and fair price discovery, creating concerns for the investor. And these concerns are not only on the basis of their liquidity point of view, but some concern of income tax and some concern on other aspects are also there. So additionally, there have been representation to SEBI from market participant to allow free price discovery for these companies, arguing that regulatory limit like circuit filter prevent their shares price being priced closer to the true value of their investment, thereby contributing to significant price variance and low liquidity. And the market representation, they are talking about the same type of price discovery like in IPO, like relisting of a company, and some illiquid company shares price discovery process, which stock exchange has, they want to do, and they want to identify of these companies. In this regard, SEBI has come out with a consultative paper on framework for price discovery of shares of listed companies, companies and listed investment holding company. The deadline for submitting comments to SEBI is May 10, 2024. So as today our objective is of this webinar is to seek comments, views, suggestion from the panel of experts and participants on the proposal to lay down a framework for price discovery of shares of listed investment and investment holding company whose market price is significantly discount to the book value. Friends, as you are aware, the corporate professional is always ahead to organize these types of programs, so we can take the view for the market on a larger basis, larger participation is there, and then we are discussing on various aspects so the regulator can also get the feelings of the market and feelings of each and everything. So today we will discuss the entire concept, issues, problems, and what SEBI is proposing in the concept paper. It has any practical problem or they have not covered certain aspects, that all will cover today. Today we have requested a very our guest speakers. It's a very learned panel today. We have representative from SEBI, we have it from stock exchange and the tax expert and the market. So the way we can threadbare discuss all aspects and then we can come out certain solution, certain issues, and the people will ask question answer on the basis of we can recommend to SEBI the best possible suggestions. So I extend a very hearty welcome to our guest of honor for today's webinar, Mr. V.S. Sundaresan is Executive Director in SEBI. He is joining shortly. He has more than 32-year experience in development, regulation, and protection of interests of investors in stock security market and worked in various departments of SEBI. He had supervised more than 500 investigations on market manipulation, insider trading, takeover, public issue, collective investment, compliance with continuous listing requirement. He strongly believes in sharing knowledge and has delivered more than 350 lectures within India, 25 plus lectures and overseas seminar on varied topics related to security market. I welcome Sundaresan sir for this program. Then we have another speaker, Ms. Ruchi Choza, is Executive Director in Market Regulation Department, MRD, in SEBI. She looks into operational as well as regulatory aspects of functionality and security market in India with focus of M&A, asset management, and IPO. She has worked in more than 30 years in SEBI. During her tenure, she evaluated to start asset management business in India and prepared the regulatory framework for real estate mutual fund in India. And she has unprecedented exposure to the functioning of asset management industry during crisis of 2008. Ruchi Madam is joining shortly, and we welcome Madam in her absence. Then we have other London speaker, Miss Barsha Agarwal. She is General Manager in SEBI. She has more than 23-year experience in SEBI and now looks into integrated surveillance department in SEBI. I welcome Barsha Madam for today's webinar. Then we have Mr. Avishkar Naik, is a Vice President in Listing, NSE. He has been working in the NSE for the last 19 years and has headed various departments such as investigation, surveillance, clearing corporation, technology, and listing. He has been awarded CA Professional Achievement Award of ICAI, and I welcome Avinash for this. And he is also very learned person who is looking after the NSE listing issues. Welcome Avinash for this program. Then we have Mr. Gopal Kishan Iyer. Gopal Kishan Iyer ji will join because he is not well. So he is on the way to his home. So he will join after some time. Mr. Gopal Kishan is a Chief General Manager of Listing, Compliance at BSC. He has been with BSC for more than 25 years. Experience in listing, broker supervision, membership compliance, investor services, monitoring of compliance of listed companies, IPO and delisting process, and investor complaints against companies and brokers. Join. Doctor, I welcome Gopalji. Then we have a Dr. R.K. Agrawal. We have requested him especially because he's a tax expert. So certain issues relating to this particular thing will emerge in the taxation aspects also. And I have requested especially to deliberate certain issues. So he is a partner in Rakesh Raj and Associate. He is a chartered accountant and company secretary, cost accountant, in addition to his MCOM, MBA, LLB, LLM, and PhD. He has been 35 years so standing as practicing chartered accountant. He has been member of Accounting Standard Board of ICAI. He was chairman of NIRC ICSI in 2003. He has worked in various capacity, and he has been elected as the president of Faridabad Income Tax Bar Association in 2000. I welcome R.K. Agrawal ji for this program. Then at last we have a Manoj Kumar, partner and head M&A and transaction corporate profession, and Manoj will discuss about from the market point of view. So friend, today the program is little bit complicated and technical, and that's why what we have done, we have identified in such a manner that first Mr. Manoj Kumar will give a presentation of the SEBI concept paper. Then I will take the regulatory viewpoint from Mr. Sundaresan, Mr. Chikochar, Varsha Agarwal, and then I will take up the understanding of the stock exchange, how the stock exchange will do. The Avinash and Gopal Iyer will discuss, and then taxation implication. I will discuss few questions relating to 56AC from R.K. Agrawal. So without wasting a time, I will request Manoj Kumar to give his the overall view of this concept paper. So everybody who is participating, he will understand, and then we will start discussion on each and every point. Over to you, Manoj.
Good afternoon, Sundaresan sir, Ruchi ma'am, Varsha ma'am, Avishkar sir, and all other participants in the group. So today's topic is very interesting, and this concept paper is one of the important regulates. It may be converted into one of the important regulations to manage the market. The intent and object of market regulator SEBI has always been to provide a free and fair price discovery and fair play in the capital market, for which they continuously upgrade, make new regulations, and this present concept paper is one of the important regulation in this direction. The problem which we are discussing today is relating to those companies which are generally not carrying major business in itself, but having investment in other companies. So, and because of this, the no direct operations, there is no price discovery, no fair price discovery for those companies' shares. So the small investors and shareholders generally does not get liquidity to sell their share or unlock their value of investment. And hence, this concept paper is discussing those aspects and trying to address the issues and concerns. Let me share my presentation here.
Yeah, this okay. Just go to slide share.
Yeah, I'm just going there. Is it visible now? Yeah.
It's visible. Just go. Yeah, it's visible. Okay, go ahead.
Yeah. So the background of this concept paper is the issue, the problem.
Manoj, you have to unmute yourself. Manoj, you have to unmute. Yeah, Manoj, now presentation is not visible.
I hope this is visible now.
Now go to first slide.
Yeah.
Yeah.
So I was just discussing the background behind this consultation paper, which SEBI has come out recently and has sought public comment on it. So the biggest issue with respect to these kind of companies, the companies which are not carrying major business activity, but holding shares or investment in other companies, including majorly in other listed companies, that there is no reflection of fair market price as compared to the book value of the company. So book value is much larger than the current ruling market price of the company. Then there are many buyers for those companies because obviously the price is less than the fair value. So there are many buyers, but there is no seller because sellers feel that they are not getting fair price and hence they are not willing to sell their shares. Then, and because there is no continuous transactions, there is no fair price discovery. The biggest rule in the capital market is that there should be free buy and sell transactions. There should be buyers, n number of buyers and n number of sellers who trade in the market so that the price discovery can happen. And if there is no seller or there is no buyer, then the price discovery would not be fair and reasonable for any company. So this is the problem in this case. Hence, to discover the fair price of those companies, SEBI has come out with this new mechanism and discussing this. So now we should discuss what kind of problem is this. If we talk about we have taken this data from the consultation paper itself, where SEBI has extensively carried research on those kind of companies. So there are around 70 companies which are asset holder investment company or investment holding company. And out of these 70 companies, there are 28 companies in which the price is they have invested in the listed company's shares, another listed company's shares, and their investment is substantial. It is not that they are holding 5% or 10% of another listed company, but they are holding substantial share in another listed company. And then their market value is much lower than the book value. A few examples are here, like illicit investment company. Here the book value is much higher, that around 3,89,000 is the present book value of the company, whereas the VWAP of the company's share in the capital market is only 3 rupees 37 paisa. So there is huge gap between the book value and the fair value. We can see that there are different problems with each of the companies. Like in case of illicit, 75% shares are held by the promoters, but the rest of the shares are also, I think, not scattered in large number of shareholders, and hence there is no trading in the company. Similarly, in the VB industry, there is a huge gap, around 800% gap between the book value and the fair value. Same goes for Amrapali FinCap or Kalyani Investment or JSW Holding Company. Some of the companies belong to very large group like JSW or Kalyani Investment, where there are many listed entities below them which are very well getting traded, and there are fine market price discovery for the invested companies. Whereas, however, the holding companies are not getting traded and their valuation is not getting reflected fairly. So SEBI's consultation paper gives jot down the problems here. The problem is that these investment companies or investment holding companies are not getting traded frequently. So if there is no frequent trading, then the market price is not fair and reasonable. Price is significantly lower than the book value. This is book value is just one of the parameters, but it is the easiest parameter to check that the price should be, or the value the investor should get should be at least the book value. Whereas here the price is much lower than the book value, so the seller would not get the fair value for their investment if they want to sell their investment. In most of the company, there is no major operations. Hence, the profitability and revenue, top line, bottom lines are not very good. So quarter to quarter result also does not reflect major change in the structure of the company, financials of the company, and hence there is no traction for these companies in the market. Due to these there are adverse effect on liquidity, fair price discovery, and interest of the investors of these companies. Those persons who have bought the shares and knowing or understanding that it has inherent value, invested value in the subsidiaries, but because they are not getting the fair value to unlock their investment, it is not a correct situation for the investor, a small investor. So SEBI has established various mechanisms to ensure fair and transparent pricing for all kind of companies. Like they generally, to start with, in case of IPO, there is always a call auction in the first day of the trading, and there is no price band, so share can go anywhere, and based on the buyer and seller's demand and supply, the equilibrium price is determined, which is from where the trading starts. Same happens for those companies which are getting relisted after suspension or after certain corporate actions. So such mechanism is available for all the companies which are getting first time listed or getting relisted. But post that, there is a provision for different differential price bands. So there are different price band, 5%, 10%, 20%, which is meant to reduce the volatility in the market. And this depends what kind of company is there. If the company is listed only on one stock exchange, then there will be different criteria. If the market capitalization is much higher, then there will be different criteria. Besides that, also the market regulators and stock exchanges put different restrictions on trading with, like ESM, GSM, to prevent unnecessary volatility or price movement in the existing companies' scripts. Then if the company is very much illiquid, then there is a provision for periodic call auction, where the shares are not generally traded on daily basis, but on certain day, on periodic call auction, the price discovery happens, and so that the shareholders who want to exit from the company can get the liquidity, and those who want to buy the shares can get the investment opportunity. So there is a discount to the consultation paper talks about that these companies further analysis that total assets of the company invested in the listed company, out of these 70 companies are like this. At least 25% or more companies have invested. 28 companies have invested more than 25% of their total asset in a listed company, another listed company, and the companies VWAP to the book value is more than 16. So they have categorized different kind of companies and analyzed in detail what kind of companies these investment companies or the investment companies are. The general price discovery mechanism is that there is a price band, and out of within this price band, buyer and seller can put their bids to buy at the, let's say, upper band or lower band. And if the seller are willing to buy or sell their shares at those called price, then the transaction happens, and this becomes the next price of the company's share for the next transaction. However, for these companies where there is no liquidity or there is no seller or buyer, then a special call auction mechanism will be implemented, where there will be no price band, and this call auction will allow buyers and sellers to put their fair price, whatever they feel is the fair, and then if there is matching buy, then there will be transaction, and that will be the discovery price for the next transaction. Existing provision is that call auction session are used for a specific time for price stabilization. However, the proposed plan is that the special call auction for these investment companies or investment holding company will happen every year, at least once in a year, so that the price can get reset. Then for asset investment company, there is no special criteria for such kind of company. However, here they want to make a special provision for those companies where the minimum 50% of the total asset is invested in another listed company. So listed company makes it easier to determine what is the value of the investment and the basis for the discovery of the price. The price movement and volatility. So to ensure there is no major price movement or volatility in the script of certain companies, there are certain measures like surveillance measures or measure of like ESM, GSM. Those measures are there, and then the price bands are there. However, for this call auction, there will be no such restriction on the date of discovery price discovery process. This process will be transparent, and there will be regular proper disclosure, so that there is enhanced pre-auction disclosure relating to the financial investment details, etc., which is generally not available except where the person investor goes to the balance sheet and look into all those information. But here, before the call auction, the mechanism provides, or the draft mechanism provides, that there will be proper disclosure of these information to the investor at large, so that they can take an informed decision. The participation, there is further proposal that the special call auction would be considered as success only when there is at least 5 unique buyer and unique sellers who want to trade in the shares of that particular company, so that there is a valid price discovery. If there is no such participation, then this process would go on for the next date also. So this process will continue till there is a such 55 unique buyer and 5 unique seller who want to buy, and based on their buy and sell demand and supply, the equilibrium price will be determined so that the trading can happen. So eligibility criteria for those company on which these mechanisms would be applicable is: first, the company classification as per the existing norms should be either investment company or investment holding company on the stock exchange, either BSE or NSE, as the case may be. Then the second criteria is that the script should be listed for at least 1 year, and the company should be compliant with all the listing regulations, and they have disclosed their audited financial results, etc., so that the informed decision making can happen for the investors at large. Then third criteria, which has been proposed, is that at least 50% of the company's total assets should be invested in another listed company. And fourth criteria is 6 months volume weighted average price of such company is less than 50% of the book value of the company's share. So if the price, there is a big gap, then only this company will be picked for this special call option mechanism. The process will be obviously run by the stock exchanges, NSE and BSE, in coordination with each other, as happened for a newly listed company or a company getting relisted. So there will be proper dissemination of information, which will be not less than 7 days in advance to all the shareholders, investor community. The auction will be deemed successful only when there is at least 5 unique buyer and sellers who participate in this call auction process. If it remains unsuccessful on a particular first day, then the auction will continue to the next day until the new price is determined. And from there will be obviously the price band and in which the company is getting traded. So that will be implemented by the stock exchanges. Auction pricing mechanism, format, risk management, equilibrium price determination, etc., will be very much similar to the IPO or relisting process. So this is the broader criteria or the framework which is being proposed by SEBI to determine the fair price and to create liquidity in the shares of these companies. However, they want obviously the market participants to give their views, and that views can be given on particular detail given by the SEBI in the consultation paper. So we will discuss threadbare on the issues so that comments can come in a proper manner. Thank you very much.
Okay. Thank you very much, Manoj, for giving this detailed concept paper note. Now, Sundarshan sir is there. Sundarshan sir, are you there? Okay. So this concept paper, the program structure, what we'll do, because now this is a new concept and there are some issues also in this. So we will do it more on question answer. So I will start with Sundarshan sir. Sir, what is your view about this consultation paper, and what is the need and why SEBI has come out this, and how this can solve the problem of various issues in the market?
Thank you, Mr. Pawan, and I thank corporate professionals for continuously taking this type of very good initiatives, and especially organization like SEBI is a very big beneficiary because of your webinar, because a lot of people participate, they express their views, which actually guides SEBI to frame policies. And also, the market is well aware that what type of intent the SEBI has while framing the policies. And I am also thankful to Mr. Manoj, because he has nicely summarized the background of the paper and the reason why we have come out. I just wanted to add that, a couple of points before others pitching and offer their views. See, one of the main mandate given by the Parliament to SEBI is to protect the interest of investors. So, as rightly pointed out by Manoj Kumar, these are all companies where the price in the market as on date does not reflect even the dividends which they will be getting from the listed companies' investment. Forget about what is the market price of the their investment and all these things, because the market price and all is varying. But if you see the track record of the dividends declared by those investee companies, that is the actual revenue of these holding companies or the investment companies. So even if that company does not have any operation, does not have any business, may not have employees, but still, at least the dividend should get reflected in the share price. Unfortunately, in some places, it is not. Maybe in one or two cases, it is as up to the dividend level or slightly higher than that. So in those companies, there is a need, and some of the investors have been directly and indirectly approaching SEBI and various forums where we have gone to do this investor awareness. People have expressed, of course, without naming the company or the actual investments they may be holding in those companies. They were asking SEBI that why SEBI is not coming out with a fair price discovery mechanism, and why not enable the person who is actually holding the shares, he wants to unlock his value. Now, if he goes to off market and do some transaction, you know what type of things happen. People will try to negotiate this, negotiate that. Similarly, a person who wants to trade or buy in these shares because he knows that these companies' shares are worth and the way they have invested in other companies, the business in those investee companies are growing. Therefore, it is a good investment. Now the seller wants to buy, sometimes the buyer wants to sell, but both are not happy with the price at which they want to deal with on the stock exchange. Because there is no fair price discovery, as rightly pointed out by Mr. Manoj. So, we have been debating this issue for quite some time. And now we thought that since the number of companies are substantial, it is not one or two, because if it is one or two, we can say that, it may not be appropriate to come with any policy. But since the number of companies are quite significant, and if you do more and more research, you will come to know that there may be more companies, because this is what, as you rightly said, from the BSC site or from the NSE website, with a basic information available, and back of the of calculation, we got about 70 odd companies. But if somebody does a research, probably you may get more companies. And as you rightly said, in most of these companies are MPS compliant. That means 25% of the shareholders are public. The promoter may not like to trade, promoter may not like to, deal in that. So it is definitely necessary for those investors to deal with. Another angle which has come to my mind, of course, it is not reflected in the discussion paper, is in these companies, even if you take the promoters, if there is a family settlement or something, on what basis they will value this company? Because they are listed, but the market price is showing 50-60% discount to the book value. And definitely in case of your family partition, if it is that too, in case of partition which is forced upon due to various reasons, the people should get the correct value. Because once it is listed, the purpose of that is fair price discovery. So even the 25% of the investors is not only the interest of SEBI, but even a substantial stake held by the promoters. For any reason, if they want to go for a settlement, or if the promoter wants to pledge his shares to diversify his business into some other thing, he will not get any value. Because the lenders will not accept the notional value, they will ask for the market price. Because tomorrow, if there is any problem, if the lender wants to sell, he will not have the market to deal with. So the problem is actually very big. But of course, many things are not written, and that is why it is all, I am my personal view that we need to facilitate by providing some mechanism for all the investors in this company to discover a fair price and leave it to the market. Who wants to buy, who wants to sell, it is their choice. But as a regulator, it is our responsibility to come out with some solution to provide a mechanism for fair price discovery. So one of the mechanisms we thought is modify the existing call option. Because any other, method suddenly, may give room for any other complication. As rightly said, there is no surveillance issues here. There is no ASM, GSM when the market call option is done. So we thought that this call option system existing one is working very well. Therefore, why not make some modifications to that and facilitate this auction mechanism for these companies? So this is what, we thought of it. But again, as you know, the way SEBI always takes decision based on the input from the market participants. So with this, I will leave open to others to contribute, and we welcome the views from this webinar. Please consolidate and forward it to SEBI so that it will be a very good input for us to take the final decision in this regard. Thank you, Pawan. Thank you all.
Thank you very much, sir. Thank you. And we will definitely compile all the questions, and we are doing poll also in between. And all these points, we will give it to you. And the suggestions, the issues, the point which we will come out today's discussion, like you have just now mentioned about the dividend and the pledge of shares, so promoter cannot get. So all these things, new things will come. So now I will request till the Ruchi madam joins, I'll request Varsha Agrawal to share her point so we can get a view, and then I'll request the stock exchange Gopalji and Avinash to share. Then we'll take question answer. I have received around 20-25 questions, so we will discuss each and every question. Yeah, Varsha madam.
Good afternoon, Mr. Pawan, all the participants, ED sir, and everyone. Thanks for inviting me for this seminar. Let me start with the disclaimer that this is my personal opinion. Whatever I am sharing, it is not necessarily the opinion of SEBI. And I won't be going into detail of the consultation paper because I believe all the things have already been covered. I just want to highlight 2-3 things. First is, as sir already pointed out, this is basically a step towards the SEBI's preamble, that is the protection of investors. Whenever SEBI comes across any issue that is being faced by the investors, we try to handle those situations in whatever best possible way. And this we thought, this is a new way we want to handle now. We are not forcing anything on the market or to the people. We are trying to take as many views as possible so that we can have a holistic view. We can have a policy in place where everybody is agreeable. because we want to address the issues that are being faced by investors, but their inputs are welcome for this process. And one more thing I wanted to add, when Mr. Manoj was making that presentation, he gave some names of the companies. So that names of the companies were not part of that consultation paper. That is as per the
Yes,
I
it
think
is
that-
BSc data. Yes.
yeah, as per the research which is done by Mr. Manoj Kumar, it is not as per the consultation paper. So I just wanted to clarify that. Rest all, everybody can chip in. We are waiting for as many comments as possible so that we can have a holistic and robust policy in place. Thank you.
Thank you, Varsha Madam. This research we have done on the basis of our own understanding from the data, and then we have given this. This is just an indication that what the concept of SEBI is, the difference between the price of book value and the market price. Yes. Now, as you are aware that this particular thing, concept paper US come out, but ultimately the responsibility of the stock exchange. So now stock exchange have to do, and stock exchange, when they are doing work day and night relating to various aspects, fixing price of IPO, relisting and other thing. So they will do this also. So what are their call on this and how they are identifying this particular point? So I'll request Gopalji first, because he's not well and he's talking from the on the way to his home. So Gopalji, I will request you to share your point. Then I'll request Avinash to share a stock exchange point of view, that what problem you are foreseeing and in the implementation and how this will come. And two points which I'm just raising. One, Mr. Sundaresan has mentioned that there are so many other companies also. And one problem which I have found, that there is a difference between the classification of the company industry in the from the stock exchange side, even BSE, NSE stock exchange, as well as the market participant like money control, like capital market. These are the data which they are providing. They have a different type of classification of the industry. So that's why finance, trading, investment holding company, trading company, there's some missing company, so that we have to see, and that I'll take views. So Gopalji, I'll request you to just share your thought.
Yeah, thanks, Pawanji. Thanks, everyone. So first thing on this issue, which you have stated that that the industry classification is different. I'd like to state that both BSE and NSE have a common 4-level industry classification, which is standard across the market. So for the same company, you will find the same classification, because if it's a commonly listed company, you will not find a difference. That's one thing. And the industry classification is also standardized between both the exchanges. So you will find you'll not find a difference. Of course, this classification is between the exchanges. We do not have. I mean, this may not be in line with what the other private players like Money Control or any other analysts would use the industry classifications. That's one thing. So here we'll be going by the standard industry classification, which is going to be followed by the exchanges. That is one thing. And second thing, for the price discovery, as SEBI has very clearly pointed out, even in the consultation paper, as to they are very clearly articulated as to what we would be considering. I mean, views are being sought from the market participants on this price, how we need to determine, and very clearly the outcome is that we need to have a price discovery which is fair enough for people to transact on the script, and also allow entry and exit of the investors. So we will be having this mechanism. So there will be some tweak in the current listing to accommodate this particular mechanism. The third thing would be that the exchange would also be seeking I mean, once the final decision and final framework is put out, we will also be working out on the nitty-gritties as to how we will be putting out these details. Because as you know, that the information will be a slightly dated information. Because if we are going to rely on the audited financial results for this, but by the time the audited financial results come in and we get those details, and then we also would require the details of the investments in those companies. So we may need to seek certain details from the companies whenever when we frame the timelines for implementing this proposal, because as the paper clearly points out, it's going to be a once in a year the event for these companies. So we'll need to seek certain details, because it should not be that between the so it should also take into account any changes that may have happened between the closure date and the date on which we would be implementing these proposals. So there will be some sort of an information which we may need to seek from the companies also when this. So that nitty-gritties we will be working out, both BSE and NSE jointly with SEBI, and then as been stated in this document, we will be giving sufficient notice to the market so that the investors can absorb the information and then can decide on what should be the price at which they need to participate in this mechanism, so that a fair price discovery is established. So I would stop here and I would let you take it over.
Okay, thank you, Gopalji. Thank you. Giving the positive note that the stock exchange is ready to take up this particular thing. And thanks for informing the BSE and NSE as a standardized industry. But I will, because both the stock exchanges are here and SEBI is also here, I will request that market participant like capital market and other people, they should also follow what the stock exchange is doing. Otherwise, they are creating unnecessary confusion in the market for industry classification. This is just one suggestion, other than relating to, not directly related to this topic. So now, Avinash, your point of view, then I will take up questions.
Yeah. Good afternoon, sir. It's always a pleasure to be part of this webinar. So what I have tried to do now is say, because Manoj has covered this entire paper very thoroughly, I have tried to create a small PPT on the intricacies, in the sense how exchange will be handling it. I will just share that particular slide.
Yeah, you can.
So you are able to see my slide?
This is industry classification?
One second.
Yes. It's, just go to the slideshow.
Yes.
Yeah, this is clear now.
So as Gopi sir also said, in the last 2 years through this Market Data Advisory Committee, MDAC, what both exchanges have tried to do is bring about a common standards, in the sense for classification, the 4-level structure which sir was referring to. So any listed entity on the exchange platform currently is now being classified in this 4 heads, where it's under this macro, sector, industry, and basic industry. So at this juncture, we have some 12 macroeconomic sectors, 22 sectors, and 59 industries, basis which all NSE, BSE listed companies are being classified. So again, if we see that document, the link which I have shared in the earlier slide, if we go in that, then the type of companies which we will be shortlisting is this two. Under the financial services, there are 2 subheads, where one is the investment company and second is the holding company, which are from this 2 broad headers, the companies will be pulled out for or shortlisted for our analysis purpose. Now, just in the sense, just to take our participants through what all nitty-gritties are there, and why I'm just taking it is, it's very important that when we implement it, people who are shareholders or investors or market participants should be aware on how this entire process works. Otherwise, what may happen is, say, example, if we decide that, okay, tomorrow we will be holding a call auction session. And if there's no participation, people don't understand how that call auction session itself takes place, then the entire exercise goes for as a waste type of thing. Then they will have to again wait for a year when we again come out with the second level of exercise and all that way. So current methodology, if you see, whenever we hold a pre-open session, the timing is from 9 to 9:45. That's the time when one as a user can start putting his order into the systems. And between 9:45 to 9:55, there's a order matching and trade confirmation which takes place. And after 10 o'clock, or if there's a open price which is getting discovered in that particular session, then the securities moves to something called as the normal market, where it trades for the next 10 trading days with a 5% price band. Now, what all are the features of this particular session? So first and foremost is only limit orders are accepted during this session, and there are no price bands applicable in the special pre-open session. So the moment we say there is no price bands, it doesn't mean, say, if I am to again take an example, if the base price is 100, when I say no price band, means the people should not take it that okay, the price can go from 100 till 10,000, 1 lakh, or whatever that particular price. What exchanges currently do is they have something called as an operating range. So if, say, in our example, when a particular security is relisted, say at 100 rupees, then we allow an operating range of -85% to 50% of the base price, and then it keeps on flexing in multiples of 10, and again it's coordinated between NSE BSE. So the prices will never be that on one exchange it is you're allowed to be, or you're allowed to place an order at say 200, and on other exchange it is only 10 rupees or 50 rupees type of thing. The order book also keeps on moving in a sync manner at both the exchanges. So again, I'm just taking this illustration because there's a very, very important point in this particular example. So say if the base price of a particular security is 100, and for our hypothetical thing, it's the operating range is 10% in this particular example, then at 9 o'clock, orders only between 90 to 110 is accepted. The moment both exchanges observe that, say, example, in this case, the market trend is negative and the price of the stock is going down, then exchange keeps on flexing it. So now if you see in the second part of the table, the operating range has moved from 75 to 110. So at every point of time, the order book is moving in a sync manner, and the investor who is there, who wants to trade in this particular security, will have to place his order at the point when he wants to trade. Otherwise, his order, if it goes outside the range, then there will be a price freeze and his order will not come into order book for trade execution purpose. Then there are certain 3-4 other important rules. One is obvious that when the session ends, so order collection period ends at 9:45. Till that time, order modifications and all are allowed. But at that order matching sequence, when it begins, then there is no changes which are allowed. And the equilibrium price which is determined or the opening price which we call, is at which the maximum volume is getting executable in the trade, in that particular security. The last set of rules is if that equilibrium price is not determined, all the orders are cancelled in the system. So if I have put a base price of 100 and say for whatever reason there are no executions, in the sense we are not able to match trades on that particular day because there's a difference between the bid-ask spread, then all the orders will get cancelled and the security won't move to the normal market. It will again open a new pre-open session for the next trading day. That's the overall thing which I just wanted to highlight, because this will be very important the day we decide that we will go in for this call option sessions and all that.
Okay, thank you, Avinash, for covering very nicely and telling us how this will move. Now, before coming to this query, because you have told and the SEBI has requested stock exchange that they are coming out. When we were doing this, there is some taxation issue which has come into the picture. So I have requested Mr. R.K. Agrawal to share, and this is very interesting point which you have as a stock exchange and as a policy you have to work out. Mr. R.K. Agrawal, you have read this particular thing. I have a very specific query to you. Agrawal ji?
Yes, Pavan, बताओ.
So here we are discussing that the difference between the market price and the book value. So the book value is higher, the market price is less. So that is very clear when the stock exchange will come out this call option concept and then fix a price. Say I'm just taking a hypothetical situation that 500 rupees is a market price and 50,000 is a book value. So if stock exchange is fixing the price on the new formula, say 30,000 or 40,000 rupees, then it is very clear that you will sell in the market and the capital gain will be there on this. The difference, whatever you have purchased, you suppose you have purchased at 500 rupees, now you are selling at 35,000 rupees, which is the new call option, and the difference you have to pay. Is it clear, sir?
Yes.
Now, my point is, as per income tax, there is a concept of frequent prices, frequently listed prices. Now, these trading is very minuscule and very minuscule trading is there. So suppose I'm trading and that is not a frequent trading because the volume is very less. So if I'm selling shares which I purchase at 500 rupees and then I'm selling in the market, then the issue will come of the frequently or infrequently. Infrequently, the section 56CA will applicable. So what is your call which I have discussed with you? Can you explain this?
Pavan ji, so far as the taxation of capital gains in case of listed securities is concerned, section 50CA is there, and in case the transaction is being done at a price which is less than the fair market value of the share, then fair market value shall be deemed to be the sale consideration. That is the law. Now, point is how the fair market value is to be determined. For that, there are rule 11U and 11UA. According to that, we have to see that what is the fair market value. In case of listed securities, if STT is being paid and share is being transaction of sale is being done through the stock exchange, then whatever the price is prevailing, that is the fair market price. So in that case, there is no problem. But because in that case, section 112 comes into the play. But if even listed securities, it is not frequently traded, then they have said that fair market value has to be determined as per the valuation method which has been given 11U and 11UA. The price at which it is being transacted shall not be taken to be the fair market price. Now your point that if the price at which the transaction is being done is less than fair market value, then valuation will be required to be done as per rule 11U and 11UA. And if the fair market price is still higher, in that case, the sale consideration shall be deemed to be higher amount and not the price at which the transaction is being done, and capital gains will be attracted on the seller on the difference amount as well.
Okay, so you mean to say the presently the SEBI and stock exchange is working on this aspect. So today, suppose the situation is that 500 rupees share I purchase, which is, and the market value and the book value is 50,000. So suppose stock, there's no system of call option this SEBI is suggesting. So today I'm selling that shares to another person is 510. Even then I have to pay money, tax on 50,000 rupees because that's a fair value.
If it is frequently traded share and the transaction is being done through the stock exchange by paying the STT, then no capital gain will be attracted on the difference amount. But if it is not frequently traded share or transaction is being done offline of the stock market, in that case, the transaction has to be at fair market value.
So it means today's problem which investor is facing, that they are not in a position to sell as a higher rate because there is a restriction, but he has to pay tax on the fair market value, which has to determine on the basis of valuation. This is
Yes.
one problem. Now,
Yes, but fair market value does not mean book value is the fair market value.
yeah,
We
I
have to
got it.
go as per Rule 11U.
Yeah. Okay. Now the problem is this stock exchange is coming out with call option rate. And here that call option rate is, say the 50,000 rupees value is there, but the price fixed for 30,000 rupees as per the stock exchange formula. Now in that case also, because the frequently traded will not be there, here the trading will be minuscule. So the fair value is 50,000 as per the 11 UA, but stock exchange is coming out with call option is 30,000 rupees. Even then I have to pay tax on the 50,000 rupees.
Yes, if it is not frequently traded share, because there is a definition of frequently traded share which has been given in the Income Tax Act. If you
Oh.
don't fall in that definition and it is not a frequently traded share, then you will be required to pay tax taking the sale consideration as the fair market value, that is 50,000 in your example.
Okay. Avnash and Gopalji and Sundarshan sir, what is the solution of this problem? Because you have fixed a price on the call option, even then on the and you are also talking about 1-5 trade and very minuscule trade. So if the minuscule trade is there, then it will not be frequently traded shares. So the investor, even if he is selling at the price which you are determined, even then the fair price has to be calculated, and as per 11 UA, you have to pay higher tax.
I can only say that SEBI cannot find solution for all the problems of the investor. Whether if it is an income tax problem, if he has to pay the tax, he has to pay the tax. That I don't think SEBI will be in any position to do that. But SEBI will encourage the investors to discover a fair price, and it is hoped that if a fair price is discovered, the shares may become frequently traded. Now we are going on the hypothesis that fair price will be discovered, but the trading will become infrequent. Now, if that is the hypothesis, then there is a problem. But today it is infrequent because there is no fair price. So the hypothesis, in my view, will be, if there is a fair price, there will be liquidity. If there is liquidity, obviously, I don't know what exactly is the definition of frequently traded under Income Tax Act. Hopefully, it may meet the requirement. And in the interest of investors to get the advantage of that, probably more investors may come and trade. I mean, we can only hope. But if all these things do not happen, then income tax will go by Income Tax Act. Fact discovery, whatever is discovered, that is discovered. That's all. I don't think SEBI can have any other solution for this problem.
Right. So
Yes,
what?
yes, Pavanji, I do fully agree and subscribe his view, because in case SEBI fixes some fair price, then either the share will become frequently traded, because at fair price, lot of investors will come who will sell their share, exercise the option. Then it will come out of the definition of the not frequently traded share. Or secondly, when SEBI is fixing the fair price on some basis, then the valuation of the price may be the fair market value which can be obtained from the valuer or merchant banker, would be the same value which SEBI is fixing. It will not be the book value, which we are presuming is the fair value. So in that case also, if fair value is the same as per the, if SEBI is fixing the fair value, the valuer will also make the valuation at that value. Then also you will come out of this problem.
Yeah, Avinash, you were saying something.
Sir, SEBI, please, Pawan.
SEBI is not
Yeah, yeah,
does
yeah.
not
the price, yes, sir.
SEBI does not fix
SEBI is
any
just
price.
giving the platform.
SEBI
Yes.
leaves it to the market to fix the price. Please,
Right.
let us not get into any such a mischief
Yes.
problem. SEBI never fixes. SEBI will provide a mechanism to
Mechanism.
the market to fix the price, discover the price. Nobody is fixing anything here.
Yes.
Yes,
Okay.
but the mechanism which will be provided would fix the price which will be nearer to the fair market value, and that valuation can be adopted by the valuer as well.
Sir, what Mr. R.K. Agrawal is saying, that valuer can take that value and then they will fight with the stock exchange that SEBI's system has prescribed.
Pawan, I am not saying valuer can blindly take that value, but rather in 11U, there is some logic that how the valuation is to be done. So therefore, we should not make the presumption that book value is the fair value. When valuer is making the valuation, it can be less than the book value. And when SEBI is providing a mechanism, that mechanism would be more nearer to the reality of the fair market value. And that's why the valuer may also reach to the value which the mechanism provided by the SEBI is prescribing.
Okay, that's it. So, Avinash, you were saying something?
So that what Sundareshan sir was also, because say this infrequently traded shares which Agarwal sir is referring to under that 11.2 needs to be checked further, because say if that was the case, well, on say on the exchange platform there are currently more than 5,000 listed entities. That way, there will be a large number of securities which will be falling in this infrequently traded basket. In the sense, whatever is provided in the takeover regulations, also that 10% thing, there are also a large number of securities. Then market participants would have definitely raised this particular aspect. So 11U, as per my understanding, is where it is not traded, in the sense on the exchange platform, or where STT is not being paid, there this all nuances will come in. If it's listed on the exchange platform and STT is being paid, then there won't be any such issues and all that.
Manoj, you want to say as a valuation? What?
So yes, sir, actually the takeover regulation clearly says that the company will be considered to be a frequently traded when at least 10% of the total shares are traded during last 12 calendar months. But that definition is not available in income tax. Income tax simply says that it should be quoted on regular basis. So quoted and traded is a two different thing. If there is a quotation every day of X price or Y price, last traded price may be considered to be a fair price if the transaction is happening on open market. And here the platform which is being provided is much more fairer, because it is being given to all the persons to participate in auction, and buyer and seller will negotiate in a way, and then an equilibrium price will be determined. So I think that price can be considered to be a fair price for income tax purpose also. And obviously, as RK sir was telling, that if it is through a fair mechanism, then the valuer also can consider that price as a fair price for the purpose of income tax. Because this provision of 50 CA is anti avoidance of tax provision. So if it is logically justified, then obviously income tax department has to agree to that price.
Gopalji, you have any point on this?
No, nothing specific, but at least what would happen is whatever today trades are not happening today, at least at the fair price discovery, it will still happen. Even for an hypothetical case, like for example, like the example that you said, that 500 is the price at which it is traded, but still you need to pay capital gains tax as if to be taken at 50,000. At least now, even if at 30,000 you consider 50,000 as the capital gain, at least you have realized 30,000.
Yes.
So you will be paying tax on an amount which is realized. Otherwise, at 500, you are still going to pay a capital gain tax, which is more than your sale consideration. So at least it is closer to the fair price. And like everybody has expressed,
yes,
the valuer also will come to the conclusion that whatever is being traded through a transparent mechanism, because stock exchange mechanism under the SEBI framework is supposed to be a very transparent mechanism for a price discovery. So that ought to be considered as a fair price discovery, and that would be the fair price for that stock.
And Mr. Agrawal has said that is right also. When the valuer will do the valuation, so he is not going by book value. He is going by the fair market value. So he can say that this price discovery by the stock exchange mechanism is a fair market value because all the participants has given option to participate and this has come a fair market price. So valuer can take this price easily, and income tax may accept this amount. And that is yeah.
So one more thing which is different is, say, in a normal pre-open session, in the sense call option, with one trade, in the sense one buyer and one seller also we can discover a price. So theoretically or whatever, practically one share trade also can determine the price. Whereas in this particular discussion paper, if we see, we have said 5 buyers, 5 sellers, means it actually gives that it's not some random trade which will be determining the base price, but well thought of, means 5 buyers, 5 sellers will be determining the price.
Okay. So any other person, RKG, any?
Yes, merchant banker can adopt the cash flow discounted method or any other suitable method for the purpose of valuation. And then the mechanism which will be provided by SEBI would be much more realistic in assessing the fair price. So I think this problem may not be there. And in course of time, share becomes frequently traded, then whatever price it is being transacted, that would be taken to be the fair market value.
Okay. So Avinashji and Gopalji and Sudarshan sir and Varsha madam, when we were making a concept paper, this particular point when we are saying the investors, how to help investor. So this is also help which you are coming out with call option. It's a highlighted problem which should be part of this concept paper. When you are coming out with final note, you can mention this, that today investors are facing, they are not getting a right price, as well as they have to pay higher tax on this, which is not realizable also.
No, the taxation part can be left out because that is not the concern of the stock exchange or SEBI, because that is a different subject altogether. Because we don't have to address the tax issues here as long as we provide the basic objective of this is to determine a fair price discovery. Now that doesn't look into whether this also takes into account a taxation aspect or not, because that is for the tax to deal. So in my view, the final outcome need not address tax issues. Otherwise, tomorrow somebody else will say you also address a GST issue or something. So many issues can come up, right? But that was not within our domain. That's my personal view on this.
Okay. Varsha madam, you have any view on this?
Also, we won't be able to incorporate tax issues when we come out with the final thing, because that is out of SEBI's purview.
Okay. So I think we have taken views from everybody. Now I have received various questions, so I can start questions, and on the basis of we will come out, and simultaneously we are doing poll also of various questions. On the basis of we can take views from others. I think yeah. So the first question which has come out: if listed, they are already on the trading platform. If a long-term investor is getting some of these shares very cheap and hold for the when any interested buyer will interested to buy and pay good price, they will buy. I think so.
Just a comment, sir. I think in continuation of earlier question, yeah. So
I think
Mr. Sanjeev has talked about the price discovery mechanism, and it's saying that SEBI should not control. So nobody should control the price. That I have already replied, and I think that it is just a platform, and the buyer and seller will determine the price, not the market regulator anyway. So it will be based on the buying selling tendencies of the investors. and not by the regulator. So just a platform which is being provided without a price band. So
So
that
stock
is a
exchange-
continuous
Yeah,
comment.
stock exchange is providing, they are a facilitator, they are not determining the price.
Yes,
Price is determined by the buyer and seller.
yes.
Okay. There is a no definition of frequently traded in section 50 CA.
Yes, we have discussed that it talks about regularly quoted regularly with regularity. It is not talking about the infrequently or frequently traded. So if it is getting quoted every day on the stock exchange at a price and there is only very few shares getting traded, still it can be considered to be traded. And if the auction happens, let's say 5 buyers and 5 sellers are there, that price would obviously be considered, may be considered as a quoted price, regularly quoted shares, that under income tax.
Okay, next question is call option price found during the process has to be the fair price, fair value, which Mr. R. K. Agrawal is mentioning. It is that person is giving
Yes, comment. Yes, yes.
Yeah. Then I think there will be no income tax on hypothetical shares value. Only actual value received will be the considered unless there is a related party offline transaction.
It is again a comment that
But this comment is not correct.
Yeah, so no, it is just saying that if what you are saying, the fair value book value is 5,000, 50,000 and market quoted price is 500 rupees, then automatic there can be tax. No, there is no such comment from anyone. It is simply saying when you trade, then at a lower price than the fair value, then you have to pay tax on the differential amount and under income tax.
Okay, value is a price which an informed buyer will pay to the informed seller. So the equilibrium price determined in the process has to be the fair value of the shares, infrequently traded shares. Okay, so now Avinash and Gopalji, there's some question. Why is the special call option designated without price band, which you have mentioned that it is not a without price band? You are starting with the initial percentage. Am I right, Avinash?
So in the current part, it is there's a operating range, so that it should not be that you put a base price and there are trades at whatever price. In the sense, 10,000 or will then face another challenge in seeing that okay, the discovered price itself is very weak. That
Okay,
Sir, so how
Yeah.
you determine the base price in case of relisted shares? Obviously, for IPOs, it is very easy because there is a price band on which IPO comes. But for relisted share, what is the mechanism for you?
So again, the underlying thing is that exchanges won't determine a price. So what we do is, before that particular security was suspended for trading, whatever was the close price becomes the base price of that particular security when it gets relisted at
Okay.
9 o'clock. And then we again let the market determine. So for us, we require only the base price so that there's some sort of a price available to market to start the bidding process. And then it's again to the market to determine whether it to take it up, down, whatever it basis that how that listing in the sense merger, demerger has taken place. That
Okay, okay. So last traded price you consider as a base price.
yes.
But if it is, let's say, 10 years old, or maybe it is just a division of a company, then what is the basis?
So we have certain rules surrounding it. Say if it's less than 1 year, then we use that. If it's more than 1 year old, then we use the face value or the valuation which we take from the company.
Okay.
Again, it's only thing is we have to keep in mind it's a base price. So
It is base price.
based on that, whatever it's the correct price, let the market determine that.
Right.
Okay. Avinaji, regarding the criteria, why is the 6-month BWAP that is less than 50% of book value significant? How does this criteria help identify companies suitable for the special call option?
So that is the time period that is being considered because you have these business this business cycles for that particular stock or whatever. So you have the stock market ups and downs. So what you cannot take one particular day's price as a benchmark to compare with the book value, because book value is again was on a static date, maybe 31st March. So we cannot take. So what is the range within the during the 6 months period that the stock has traded? becomes a fair sort of a comparison to benchmark it to the book value.
Okay. Can you walk through the specific step involved in the special call option process of the day of the auction? You have narrated, Avinash.
Avishkar
What-
sir has already narrated in detail,
Yeah.
I think.
But what happens if the required number of participants is not met?
So it will not be treated as a success, and then we will have to take it to next trading day. That one again,
So-
next day 9 o'clock the session will be held.
So how many days you will postpone this?
So this keeps on going in the sense to be just to give one stats in our current thing also there are companies who come for daily call option session and there's no price discovery taking place and it's for more than 6 months that
So you are saying every year you will do?
every day.
every
No, no.
day.
No, once in a year you will do this.
Yes.
So suppose you are starting today, continuously you postponed. It means postponed up to 6 to 8, 9, 10 months, 12 months also. Till the
Means
time.
that it will have to go on that.
Okay, okay. Gopalji, you have any additional point on this?
No.
Okay. What types of information will be disclosed about the companies prior to the auction? How do you ensure that all potential investors have equal access to this information?
Yeah. So the idea again in this particular case, even what Manojji was showing in that earlier slides, he had named 4 or 5 scripts also there. They are available for trading as on today. In the sense, if you actually you can place an order today also in such securities. So how that idea is that once we decide to go ahead with this particular framework, then we will be deciding a date when there will be a call auction session we both exchanges will be informing the market upfront that on this particular day what will be the base price on which we will be starting this call option session so there will be adequate notice to the market so that every market we can look at various options in the sense one is through circular we can also send some sort of a message to the shareholders through mechanisms like the depository or whatever in the sense the whole idea is to tell the shareholders that such option is available and they have to come so that there's a correct price discovery. If there is again less people coming in the call auction session and all, again it fails on that particular day. So that's why we will be giving adequate notice so that everyone is aware that there is a such thing happening in the security.
Can you do this also that you have a email address of all these shareholders?
Right.
You can send them also because the market participant may not be interested, but the shareholder may be interested.
Right, right.
Yeah.
So that's why I use the word depository because that is one of the mechanism through which we can approach the shareholders. That.
Okay. What are the requirements for investor to participate in the auction? Is there any pre-qualification process or can any investor with knowledge of auction participate?
There is no anyone can participate in the sense if you are registered with a trading member, then you can just place the order in that particular security.
Okay. Okay.
There may be certain other restrictions like the company is in under XT category or MT category. So for that there will be I think the additional requirement as available to all other XT companies like they have to put the margin money in front etc. So that will be there I think requirement.
So that part in the sense margins and all we have not touched. It will
Yes,
be
yes, you
regular
are not touching.
whatever
Yes,
is there. It will be.
like in case of a semi-listed company, MT companies, there will be at least 1 lakh rupees trade value. So those conditions will be continuing here also.
Okay. If the special call option does not succeed in discovering a new price after several attempts, what are the subsequent steps or measures taken?
So in the sense if it's illiquid, we are trying to give a fair price option of getting a good price, but if it's not happening, it's there.
Okay. Okay. How do you foresee the special call auction mechanism impacting the overall market dynamics and the trading behavior around these stocks? Gopalji, you can give answer that what when you are finalizing this or making this, are you seeing any changes relating to this?
No, you see, like it's been very clearly articulated that we are only providing, we are only facilitating this process of a fair price discovery. So,
Okay.
like it's been expressed, once the fair price discovery is established, then people may come in and put in their trades. I mean, there will be willing buyers and willing sellers, and then the trade would take place, which today is not happening because of a lack of fair price discovery.
Okay. How does the special call options compare with the existing price discovery mechanism? Are there lesson to learn, lesson or data from other market that have influenced its design?
When we check, there is no some comparable international practice or so. But if you look at literature and all, everyone agrees that this investment holding companies and all generally trade at a lower price than their. So in international jury, if you see, they typically don't intervene also here, at least because there's a clear case where we should be having. Our motto is easy entry and easy exit to the shareholders. In that particular thing, we are actually going one step ahead and trying to give them some sort of a way to discover a price.
Okay. Okay. Can you detail the regulatory measure that will continue to apply alongside with the new auction trade mechanism? How do these interact to ensure market stability and investor protection?
I think there is no change in the regulatory framework for anything relating to that company. Everything will continue as such. Only thing is an additional platform for trade is provided, which is in the call option session in the morning for the investors to participate. The persons who are not getting fair exit value, they will get fair exit value, so they can participate in the sale purchase of the shares, sale of the shares. And the purchasers, who want to buy at a price which is higher than the existing price and cannot put the bid because of the price band, they are getting an option that there is no price band as such on that day, particular day. So this is just a additional measure, but no regulatory change as such in the company's profile.
Okay. Okay. So if I just see this, what are the issue before the consulting paper that we realize that there is a significant discount of the book value, infrequently trading, impact of circuit filter, valuation challenge, market sentiment and investor regulatory surveillance challenge, and adverse effect of the investor confidence. That is there. But now there are some issues and gaps are there. One is the solution which you are providing, is it not create market manipulation risk? Gopalji and Avnashji, any market manipulation risk will not be there. Because removing price band during the special session could expose the share to greater volatility and potential market manipulation.
So any trade or any orders which are being placed will be subjected to our surveillance checks and all that way. So in case we observe any say unfair practice and all which is going on, then definitely we'll be able to capture it.
Okay. And the investor participation will be low because these shares which we are talking is say liquid and less popular among the investor.
Right.
So investor participation will be less. So
Right.
how,
So that's why in the initial part also I covered that on that day when we have this session, there has to be participation. So typically what we observe in normal days also when there's a pre-open session and all in many of the securities which are not very large or say a small cap type of thing, there is hardly participation in this particular securities, and that's why after the price discovery session there will be some investor coming back and saying that the price discovered by the market is not fair and all that. So in this case, it's very important that shareholders or a market participant participate in this particular
okay,
exercise.
you are absolutely right. Something is better than nothing. But the one question is there, frequency of auction in a year is not a long period. Say example, you have started a auction today and there is a trading, there is a price discovery. And then in the meantime, the value of that company has increased again, that value of investment. but you will do this after a year. So the year period is not longer period.
So there will be challenges in the sense, just to again, I'm just taking a hypothetical example. In the sense, when we agree to do this sort of exercise, we'll be taking the financial results as on say 31st March 24 or say 31st March 23, because 24 will be coming by 30th May 24. Now, when we take that particular financial, 2 months would have already been lapsed, and if say he is holding the shares of listed entity, that could be means price related thing and all, and that's why we are saying that when we have this session, we'll keep it a base price and again let the market decide on that particular valuation. That, and the whole idea is, if the share is again through this particular session, if it's a fair value is determined, then automatically liquidity will come into it. Today what has happened is, the example which Manoj was showing, if the value is so low, why a buyer or why a seller will come and sell a particular stock when he knows that the valuation is so high?
Okay. Uh, Gopalji, Avinash, is it not? This is the special call option is a criteria might be complex for average investor, those who are holding shares, and they are the shares which is illiquid. So it is not complex, or do you think it is? You will make very simple for them to participate.
So this process is already in place in the sense on call option, and if you typically see on both exchange platforms also, this FAQs and all have been explained with examples on how they have to place the orders and all that. So means at this juncture, every relisting, IPO and all goes through this call option mechanism. So the market participants is, and this particular thing is there since last 10 years. In the sense, there is a 2013 or 12 circular which basis which we are working.
Yes. I think, sir, this is very common practice. So all the brokers are well versed with this. And obviously, we are talking about the shareholders of certain companies. So shareholders, they may not be able to do it through their mobile phone, but if they call their broker, they will certainly be able to place the order on their behalf. So I think it is a very fair way of discovery. And if they are not participating, obviously there is the requirement of only 5 persons, 5 buyer and 5 seller to decide the price at least. And then after that, there will be regular trading based on the fair price discovered through this mechanism. So they can participate later on also.
Okay, Gopalji, the proposed mechanism applies only to IC and ISC, with a specific characteristic like certain percentage of asset in listed companies, a specific discount to book value. This limited scope might mean that some companies that could benefit from their price discovery mechanisms are excluded. Like take example, we are covering only the investment company and investment holding company. But other companies, because I identify the data of various companies which has a huge discount, their book value is very large, and the share price is very low. And I give one example of Hindustan Housing Companies. It is a book value is 90,000 and the closing price is 38 rupees. So the difference is huge percentage. So today we are covering only these companies. Why we are not covering other companies?
So basically, the consultation paper also clearly points out that these companies don't have any other operations, right? So
Okay.
these are companies which are earning revenue from the investments that have been made, and that too in listed companies where you can have a fair value of the asset that they are holding. And then the only income that they derive is out of the interest or the dividend that they receive. Now, if you if you look at other companies which are in operations, the valuation becomes a little complex, because then the fair price will have to take into account both the value of the listed entity, and you will have to put in a valuation of that company in operation. So if you were to look at a positive value for the, let's take a hypothetical case, that there is a positive upside because of the investments that they are holding, but the valuer or the market may put a negative valuation for the industry in which they are there. So these two combined would then give a valuation or the price at which it gets traded. So it becomes a little complex when you have to value the company itself without basing on the value of the investments that they hold. So that is why this has been considered only for investment and holding companies, because then you have to only look at the investment that is held by these companies in listed companies, rather than going into the valuation of that company itself because of the operations that they conduct.
Okay. Avinash, you have any view?
No, sir. It's Gopi sir has covered.
Okay. Sundarshan sir, do you think that after the success of this particular concept of IC and IHC, will you go to extend this facility to other scripts, other industry also?
I can't give an hypothetical answer to an hypothetical question. I can't give you a future plan
Okay.
because so it's we don't know. I mean, as Gopi correctly pointed out, how not only it is complex, it may also lead to some other complication. I don't know which I cannot visualize. Even for this, we have been struggling for last almost 2 years. Let me be very honest in admitting it, because these are all, as Gopi correctly said, here at least some semblance of value can be easily identified, and it is actually reflecting. For that only we have struggled to come out with some formula. Now for other companies, I do not know. Very good that the investor has cited one company. I do not know how many such companies are there. Honestly, see, without knowing that number, I can't say whether there will be a need for policy or not. First of all, there should be a need. If there are 1 or 2 such companies, then I don't know, is it necessary to come with a policy change? Here we found there is substantial, companies available, and therefore we need to provide a mechanism. If such problems exist, I think investor can approach SEBI. SEBI, the concerned department, will evaluate. And if there is a need, yes, obviously SEBI may come out with that. So all these things are if.
Okay. Okay. There's another question. Can SEBI give a mandate that ratio of paid up equity or to free reserve should not cross a threshold? In most of the group holding companies, the management does not reward the shareholder according to the worth of the company. Can SEBI give the mandate that ratio of paid up equity or free reserve should not cross a threshold? Avinash, can SEBI give this?
I think it is a website, not a logical question. SEBI never participate in the price discovery or fair valuation. It is just a matter of they are providing, stock exchanges are also providing the platform and information. If the information are sufficient and based on that you are making investment, it's your call. You cannot compel the management to give bonus or a dividend or anything like that. That is a management call. You are participating as a shareholder in the companies. So if you have sufficient number of shares, you can participate in the voting process and then compel the company through that process. Nothing more than that can be given.
So what Mr. Gopal has said that other company we can't take it because there is not clarity. So it is very clear that if the investment is a listed company, you can calculate. And if the investment in business, then the question of valuation is there and multiple valuation can come. And the investment in the unlisted company, that is also another issue, that how to value this. So that point is very clear that for future, this is the easy target and low hanging fruit that is happening. I was just taking out the Plani investment. The market capitalization of Plani investment is 4371. But if I see the 33% they are holding in Century Textile, and the Century Textile is market capacity 22,000, and the value of 33% is 7,384. So there is a clear that 7,384 is the value of this investment, but their overall value is 4371. So this is a discount of 40% which is going on. So that's why if this is clearly defined and it can take place. So I think we have tried to cover all the points which we discussed. My last few suggestions are there, that some point which I raised, that these issues are there, these problems. If SEBI can or stock exchange can have a better enhanced surveillance monitoring, then the manipulation and other thing can be avoided. For investor point of view, how they can participate, the educational campaigning can be there, or proper communication can also be there. Review of frequency of auction, which is 1 year which at present. So let's start with this, but after some time of the success of this, they can reduce this review to 6 months or 3 months later on. Streamlining the transparent process, the process which is taking place, it should be clear and timely communicated to all. Resource allocation for regulatory oversight. SEBI and stock exchange might need to allocate more resources towards oversight of this. But the only question is the number of companies are very limited. So how much you can do? And then there is a issue in future that why not other companies should include. So SEBI and stock exchange has to take a tiny step to do this. Expanding scope gradually. This is also after successful, you can take care. Though Avinash has mentioned that there's no international example they have found, but even if their continuous research can identify it, because this is a very complicated and very special thing. So international experience we can search, and policy refinement can also be continuously modify this particular thing on the basis of first successful implementation of this concept, and then use of technology that is also there to make it more transparent and more useful. So with these things, I think we have tried to cover all the points and issues which public has asked, and we have received various questions. So we try to give answer, and all the participant has given clear-cut picture. So now just take a poll, result of the poll which we have taken place, whether any special call option mechanism without price band be required for IC, whose price to book value is a significant discount or efficient price discovery. 83% say yes. And these are the poll which is a part of the concept paper. So it will be helpful when we'll submit our suggestions. Next, for identification of such IC and ISC should be appropriate percentage of asset invested in share of other listed companies. 25% and above, 36% is saying, 50% above, 50%. So 50% is more, majority is suggesting 50%. So and SEBI is also, this is also validating their point. Next, what should be the book value for identifying the list of companies eligible for a special call auction? Overall book value based on the pro rata of their investment. So now this is a question that overall book value they should take, or book value based on the pro rata. So 58% is saying book value of overall. Any Manoj, you have any view on this?
I think that is the correct parameter. I think overall book value should be considered.
Okay, next. For identification of such IC and ISC, what should be the appropriate percentage of 6-month VWAP of the script to the book value of the such company? 25% or 50% ever. So they same answer which is connected to this. So 65% is saying more than 50%. So that is also validating. For determining of the such companies which should be the appropriate time period for computing VWAP, 1 year 25%, 6 months 63, and 3 months. So majority is saying 63%. Avinash, so what is your view? This is correct, or this can be modified?
Yes, so when we were trying to draft this particular thing, there we tried to look at various things in the sense 1 month, 3 months, and all that. So basis that only we at this juncture in that document, if you see, SEBI has given that 6 months period and all, and it's open to the market again to give their views on it. But data also shows that 6 months gives a fair price at least to the market. Means fair idea on what's the price to the market.
Okay. So thank you, Avishkar. Thank you. Very good. So now next is what information to be disclosed by stock exchange along with the last traded price prior to the special call option. Latest available overall book value of the company 18%. Latest book value based on the investment shares 14%. Percentage of investment in other listed company 14%. All the above 55%. So Avishkar, this 55% mean all will not be complicated.
Yes, so this data is coming from the company's balance sheet only. They will be giving all this means when we will be implementing it, we'll be taking it the data from the financial. So latest available overall book value and all will be the data points which will be extracting, and that's why it will be easily available that way.
Okay. Next 0.67. Whether there should be any allowed price range applied to book value, the base price of for the special call auction, 79% yes and 21% no. So I think that is also on the same line which is there. Any comments of anybody, or I should move?
I think book value, yeah. So base price, Avishkar sir has told that last traded price they generally take as the base price. But here, majority believe that the book value should be disclosed as the considered as the base price for a call option. So this is we have to consider.
Okay. Next point. Whether the special call auction session shall be treated successful if at least 5 unique based on pen buyer and seller have participated in the call option session. 81% say yes. So that is also validating the point which SEBI has prescribed.
I think this question could have been that whether 10, 5, 10, 20, whatever, what should be the right number for determining. So if you are giving 5, yes, at least 5 trade should match so that it is the price discovery happens.
Okay. Next. Whether the participant in the special call auction mechanism should be mandated to bring the fund and security of IC and IHC upfront to avoid price manipulation. So this is yes. So Gopal sir and Avinash, why you have why this particular doubt that people do the manipulation on this?
So just take an hypothetical example in the sense, I'm just taking a hypothetical where people, it can be, and that's why this particular point has come up. Say if there's a call option session today, we both participate in that and we discover a price in the sense it will become the open price of that security at 10 o'clock, and that will become the base price on which say the security will start trading in the normal. And then say this particular transaction in the sense trade itself doesn't go through in the sense someone defaults, you don't provide the security, it doesn't come for delivery at all. So it's like we traded to discover a price without an intent to actually deliver the shares also that.
Right. I think this restriction is very important. Because auction should always be backed by fund, and it should be intended that the transaction happen. Otherwise, there will be many participants who don't even owning any share and trying to sell the share because there can be a short sale or short buy. So that should not be allowed in auction trading. So I think that is a correct mechanism.
Gopalji, you have any view on this? Any point with that why you foresee some issues in this? So that's why.
Avishkar has very clearly articulated the issue. So.
Okay. So friends, we have tried to give all the answer of the poll and the queries which we have received. We have covered the concept paper also, and we have discussed about the tax aspect also. And all the participants, Mr. Sundaresan, Ms. Barsha, Avishkar sir, Gopal, Kishan, Manoj, and R.K. Agarwalji has covered all the points. So it's time to close this session. So thank you very much. And I just last point which we want to always take, that what is overall view. So I'll start Gopalji. What is your overall view on this and how it can be successful?
Clearly, this is, as SEBI has also said, that it's been quite some time that they've been grappling with this issue. So now at least we've got some framework to begin with, and very, very much in the positive direction. So this will be a good learning for all of us, to understand how a fair price discovery mechanism should function, and this is a win-win for the investors who've not been able to find a fair price for their stocks. So this will be a good beginning for for everyone. Yeah.
Avishkarji.
So my whole thing is participate in this discussion paper, and then when it actually gets implemented on that day, participate in the call auction session.
Okay.
Yes, the success of this new regulation, the new law would be only the participation by the market participants and sellers and buyers. So obviously, it is very important. I think, sir, it is a very good initiative, and it may be just in the start. There may be certain other companies also, and later on, based on the experience, SEBI might come out with the solution for those companies also, because the price band sometimes certainly creates hurdle, because let's say 5% band and the fair value is 10 times. So achieving that fair value may be very, very tough for at least for illiquid companies or XT, T category, Z category companies. So I think for that, it is just a starting point and very good initiative for the market.
Okay. Varsha madam, your last comments.
In this method, we are trying to facilitate the investors which are feeling some problems, which are stuck. So it is now up to the investors to use this mechanism and come forward so that this mechanism is successful and we may move forward. So we expect investors to make good use of whatever we are providing.
Okay.
That is.
Thank you. So this is absolutely right. It's a one step ahead to discover the price of imperfect price difference between the book value and the market price. And this step, if successful, the SEBI may think of implementing for other part with some checks and balance. No doubt, this concept is new. So initially, people may shy away. Some problem will also be there, but it's a good move. And even if you can manage out of the 70 companies, 5 company or 6 company, 7 company, slowly other people will also come, and this will be a part, and this will be really a move for investor benefit, and investor will really identify this move as a good move, and they will definitely participate in this. With this, thank you very much to all my participants and all my learned speaker, Mr. Sundaresan sir, Mr. Avishkar sir, Gopal Kishanji, Barsha Agarwal, Manoj, and R.K. Agarwalji for participating. A special thanks to Gopalji. He is not well, but he is participating while going to his home. And then R.K. Agarwalji, he was not. Yesterday, I requested him that there's some topic relating to taxation also. You can just suggest. So with this, thank you very much to all for participating. And friends, our journey of knowledge sharing is continue, and it will continue. So our next webinar is on, this is 170th webinar on import and export of goods and services, regulatory ecosystem. This is a FEMA topic, which we will discuss on 3rd May 2024. And our knowledge sharing will start with 170 webinar on the 3rd May. With this, thank you very much to all.